Welcome, everyone. I'm Lorene DeBono, Managing Partner at FLG, and I'm your host today. FLG is the premier CFO and board advisory firm in the United States, and we serve clients globally. Today, we're going to dive into a topic which is key for all CFOs and CEOs, which is raising capital for growth. At FLG, this is right in our sweet spot as our partners help management teams and boards from seed stage to pre-IPO. We identify and pitch investors, and we close funding rounds to generate liquidity for companies. We have three highly seasoned FLG partners with us today to help navigate the topic, what do investors want? Each of them has led multiple financing rounds for companies and closed transactions, including lines of credit, debt and equity financing, PIPEs, crossovers, and IPOs. Patrick Nugent joined FLG in 2020 and has extensive experience raising capital for medical technology and diagnostic companies, that are focused on development and commercial stages. As a CFO, he has raised over $380 million in debt and equity financing for life science companies. Bill Leatham joined FLG in 2007 with over 30 years of financial management with companies large and small, public and private. He has successfully led 2 IPOs, which raised over $75 million and executed 7 M&A transactions, delivering $240 million to investors. Lastly, Eric Hall. He's been a partner with FLG since 2004 and has over 30 years of experience as a president, COO, and CFO at both public and private companies. His specialty is building successful life science organizations from the ground up, and then helping them navigate through strategic pivot points, including financings, IPOs, M&As, and successful exits. In the past 2 years, Eric has helped Elevation Oncology, Connect Biopharma, ALX Oncology, and Wrap Therapeutics go public. He is currently working with 2 life science clients who are intending on going public via a de-SPAC or traditional IPO process. So let's get started, everyone. Our first topic today is understanding the investor landscape. So let's begin with Eric. Give our audience, Eric, a framework for understanding the investor landscape, meaning how would you describe the different types of investors which comprise the opportunity when it comes to raising capital?
Well, thanks, Lorene. I tend to look at the investor market and a company's strategy for raising capital according to the stage a company is from a growth standpoint, seed stage to Series A through Series E, preferred stock to the IPO, SPAC, and exit stage. For seed and early stage companies pre-Series A, there are dedicated funding avenues. Funding for early stage companies is often based on existing relationships and the networks of the company founder, friends and family, colleagues, old bosses, even former companies. Early stage companies don't have proof of concept, so trust and leadership must be used to sell investors. In life sciences, for example, I've been truly impressed by the ingenuity of some founders. They can be really resourceful in attaining initial capital and also quite persuasive about the feasibility of the technology they're working to develop. Angel investing networks and incubators like Foresight Labs or Column Group and universities, state and local grant programs can also help with early stage financing. Once there is a proof of concept from a product concept, this is normally a precursor for a Series A round of financing. At this stage, the opportunities from an investor standpoint broaden to include VCs, private equity firms, strategics, sovereign and family offices, and a growing investor segment, social impact funds. Each of these investor groups has a different investment criteria, but together they form an important foundation for future financing rounds. Finally, as companies approach liquidity, say a sale, IPO, or a de-SPAC, they'll be looking at crossover and follow-on rounds. Sometimes even without revenue or profits, you can successfully execute one of these events, as many life science companies have shown. Sometimes good data is all you need. In other sectors, you might have to show traction with your customers and growth. Once a company shows both product and market credibility and a pathway to growth, then they can tap a broader variety of financing alternatives.
That was a great overview, Eric, of the investor landscape for our audience. So that was great. Now let's turn to Bill. When you look at the current landscape of financing transactions, Bill, where are the investors placing their bets?
Well, it's interesting. Deal flow at all stages of the investment life cycle is very healthy right now, but obviously large and late stage investments remain the main total dollar drivers behind the deal value trends the industry continues to see. What's really striking in the latest investment numbers is that the total amount of Silicon Valley funding has essentially doubled from $13 billion a quarter over the last 2 years to $25 billion in Q1 and Q2 of this year. A recent CB Insights report notes that in Q2, global funding to startups hit new records at $156 billion, an increase of 157% compared to Q2 of 2020, and marking the biggest quarter for dollars raised in the last decade.
Amazing.
Yes. There's also another noteworthy trend in the latest data. There's an increasing number of deals with non-traditional VC investors, such as mutual funds, hedge funds, corporate investors, and crossover investors. So it's quite a pool of candidates that companies have to navigate.
And I agree with you, Bill, that more and more non-traditional investors are eyeing those earlier stage investments that are traditionally, right, the domain of the VCs only. So it's interesting what's taking place, and I appreciate your thoughts on that. Now let's ask Patrick to join our discussion. And one question which I'm sure is relevant to our audience today is, what are you seeing, Patrick, as hot segments that are attracting investors' attention right now? Meaning, where's the action right now, and when it comes to the trending segments for investors?
Yeah, a great question, Maureen. In the medtech marketplace at the moment, the hottest segments right now include advanced telemedicine and digital health. These segments are getting a lot of attention for investment focus by investors. In Q2 this year, for example, digital health attracted 625 deals, raising $14 billion, which was more than double the average of $4 to $5 billion raised per quarter for most of 2019 and early 2020. So whether it's medtech, life sciences, or software investments, investors are always looking for solid fundamentals. These include, what is the addressable market, how will the company attack that market, how defensible is their position, what is the current traction in the marketplace, and how fast is the company growing in relation to the market. And then, of course, will the company ultimately be profitable so investors feel that there's a positive potential for a liquidity event.
I completely agree with you that solid business fundamentals is always the key for investors. And we're going to get into that more when Eric later on discusses the de-SPACing process as well as traditional IPOs. So I really appreciate everyone's insights about the overall investor market. Now let's dive into our second topic, which is making and refining your pitch to investors as a CFO and CEO team. So let's start by talking about the motivations of different investor audiences. So turning to Eric, tell us a little bit about how this works.
Thanks, Lorraine. Yes, it's so important to understand your investor audience when tailoring your pitch. I can't emphasize this enough. You've got to know who you're speaking to, whether it's to an incubator in the seed stage or a VC or a private equity firm later on. Seed stage investors need to see a well-articulated game plan for growth and product development, with evidence of solid research into market size, the competition, and with a strong team at the helm. When you get to Series A investors, you want to carefully choose these investors as they are the foundation for your follow-on rounds. They'll be participating in each round you have, hopefully, until you go public or get acquired. And you need to decide who you want for your lead investor. These investors want to see proof of concept. And company valuation, of course, is key here with these early investors entering on the ground floor. The CEO needs to have a compelling story around the strength of their team, product potential, and company valuation. VC firms are also unique animals. They typically have specific preferences and investment criteria about when they like to invest in the company. Is it early stage, late stage, or growth stage? For growth stage companies, for example, VCs want to see revenue and customer metrics and trailing 12-month minimum revenues of 5 to 10 million. And sometimes growth funds also want to see improving EBITDA or net income loss. Private equity firms are all about the financials. As you and I well know, Lorraine, they want to see that growth in the bottom line and in EBITDA.
They want to see that badly. Oh yeah.
It's all about EBITDA. PE firms often look to transform companies to be more cost-effective to fund growth, with a long-term objective to spin out the company via an IPO or using a roll-up with other like entities. They tend to look for minimum revenues between 50 to 100 million. And a lot of management teams are worried about PE firms taking a controlling interest in everything from the cap table to voting rights. But there are ways of managing investor rights to mitigate this concern. You don't have to give up your company to bring in a PE investor. In life sciences, there are also strategic investors. These might be another company or a corporate partner who wants to invest early on because they see the synergies and strategic opportunities downstream from the relationship. Maybe their product fits into the company's therapeutic product pipeline, or the company has valuable IP, for example. There are three big benefits associated with strategics in my view. First, strategic investors provide valuable credibility for a company. They help to validate the company's product concept and market opportunity. Second, they often help to attract additional investment from other non-strategic investors. And finally, strategics sometimes actually pay a lot more for a company than a pure play financial investor like PE firms because they value those strategic product distribution benefits long-term.
Absolutely.
And one final point, it's important to start courting these investors early as it can take 12 to 24 months from the start of a relationship through a term sheet.
I can't tell the audience how important that is, Eric, because so many people think that it's going to take a much shorter time than it actually does. So people really need to think about that. Financings take time.
I agree. I find strategic relationships take the longest of any financing.
Right.
But
you may get the highest valuation with those strategics. So it's maybe worth the time, right?
Definitely. Well, in life sciences, you also see crossover funds as investors. Crossover funds invest in companies when the company plans to go public in the next 6 to 12 months. They're looking to get in early and also take that bump when you go public. Frankly, many life science companies just can't attract sufficient VC capital to fund their clinical trials. So these companies must often go to public markets to raise funds. And an IPO or de-SPAC is a great way for life science investors to get quick liquidity so they don't have to wait until later stage clinical trials to see the value from their investment. It takes a long time to bring a drug to market. So being able to get in to get liquidity is very key to these investors.
Totally agree. And by the way, that was a great primer, Eric, for our audience on the different kinds of investors that are in the market today. So thank you for that. Now let's turn to Bill again, and let's talk about the financing process and the steps which occur over the course of a round of financing. Bill, you've been through this so many times. Tell our audience about how that typically unfolds with investors.
Well, unless you get lucky with your first pitch, as Eric and Maureen have said, it can be quite a long process from start to finish. So you have to start early enough to survive through the investment process. As you might expect, your pitch needs to evolve accordingly as you move through the investment cycle. In some circumstances, your company is in what is perceived a hot market. This may mean that you can get by with less robust metrics for your initial investor pitch, but as you head into due diligence, you'll still need to be able to produce reliable financials and forecasts. You will have to be able to share dozens of documents on existing ownership structure, forecasts, board actions, employee agreements, tax, and more. You'll be much happier if you get this done before you begin working with investors.
So true.
You want to start with some introductory one-on-one investor meetings. In order to attract investors to review a management presentation, you'll typically provide a short teaser to request a meeting, typically 3 to 5 slides. It's in essence an executive summary of your longer investor deck. At this point, your objective is just to get the meeting. You want to solicit more interest with more opportunities for investors to ask more questions. On the investor presentation call, you'll be presenting your full pitch. It's critical at this stage that you brainstorm and be prepared to answer all the possible questions you think investors might ask along with simple and clear responses. Once an investor group has expressed interest, typically the process then moves to follow-on meetings where you can demonstrate deeper understanding of your product technology, customer segments, regulatory pathways, competition, and you'll be able to pull in subject matter experts from within the company to make presentations and access a data room. So you'll need to prepare differently for each phase in the investor meet and greet and cultivate process.
And it takes a while, as both you and Eric have pointed out. And those are great pointers, by the way, Bill, for our audience on pitch decks and how to get investors interested in your company. Let's turn to Patrick again. Patrick, I know you have advised numerous teams in life sciences and have helped them to refine their pitch to investors. So what do you think matters when it comes to crafting the right message? I know you have a lot of experience with this.
Yeah, thank you, Laureen. You know, Laureen, working on a pitch deck is a bit like working on your resume for a job interview. You can definitely overthink it and overdo it. And everyone will have an opinion on the pitch deck, from the managing team to board members and investors. So what I found works is keeping it simple with a logic, trail, and flow, and using the least amount of presentation materials or deck to get your points across.
Mm-hmm.
Again, you always want to tailor to the specific audience you're speaking to that day.
Mm-hmm.
So I like to use a couple of simple acronyms to help guide pitch decks for medical device companies, and they are CFO and AMP, or AMP.
Love it.
Using the CFO acronym helps guide the presentation of your main value proposition for your product and the medical need for it. The C stands for clinical medical benefits. The pitch deck needs to articulate the product's clinical needs and how the product provides an effective solution for that medical need. For example, you want to include cited publications that endorse the medical need or feedback from key opinion leaders, KOLs, or feasibility study results and case studies that provide additional evidence here. The F stands for financial effectiveness. For example, for products which will be used in hospital settings, it is imperative to show the financial effectiveness of your product as compared to other existing standard of care technologies. Hospitals have value analysis committees, VACs, whose main function is to evaluate which medical products to purchase and reviewing cost versus medical benefits. And then finally, the O stands for operational effectiveness. Does your product improve workflow and patient outcomes? These data points also need to be included in the pitch deck. My second tip when crafting a life sciences product pitch is to follow AMP, or AMP. The A is for the addressable market. Because when you present the total addressable market for your product, you need to focus on the A for addressable. A lot of presenters like to show big numbers here around total market size to investors, but that's not what is important. You need to show a realistic estimation of the addressable market specific to your product.
Mm-hmm.
The M is for marketing, which includes a product differentiation analysis and your go-to-market strategy. It is imperative that in your pitch to investors, you include a clear review of how your product differentiates from the current standard of care that is in use today. Product differentiators can include technology differences, product features, pricing, patient outcomes, etc. You also want to outline your go-to-market approach. Usually, early-stage investors do not expect a full deep dive into the sales strategy, but there needs to be a high-level overview of market segments, product pricing, and market positioning, and is there a reimbursement pathway, etc. And then finally, the P stands for intellectual property. So protectable shields in place around the technology developed. These act as defensive and offensive patent portfolio strategies. Defensible patents protecting the current technology in its proposed use, and offensive patents by protecting the technology when it's used for future potential alternate uses and in adjunctive markets.
By the way, I loved your acronyms, and those were just great tips for our audience with regard to strong investor messaging. So that was great. Now let's shift to our third topic, which is all the realities of financing and the typical issues that company founders and teams encounter during the financing process. So this is where having the right advisor really matters. So let me turn to Bill. And I know you work a lot, Bill, with Series A teams. What happens in a situation in which a company doesn't even have their financials together, and we've all been there, but needs financing? How do you help them get prepared to launch their pitch?
Well, the no financials problem does need to be solved, I'm afraid. But it does start with assembling a data room, and you've got to build your financials based on the data you do have and make sure your P&L and balance sheet tie out and reconcile. Cap tables are notoriously complex, pardon me, Yeah, even in small startups, where maybe the founders have put in some cash and then later friends and family put in some money and then there were employee options. If you don't get your cap table correct, setting a price with an investor is almost impossible. So get relevant documents assembled. You'll ultimately need to load documents into a secure data room for access by investors and their attorneys. Depending on how many investors you expect to approach, you may choose to use a specialized investor documentation firm. But as a starting point, you can at least compile files into a service like Box or Dropbox. But it's not just about getting financials together when you're making your pitch, especially at the Series A stage. Sometimes at this stage, you might not even have a well-built management team. You might be going after a round in order to finance your key hires. In these cases, it becomes critical that the founder's pitch be convincing. You have to show that as a founder, you can attract the right talent into any gaps you have once you have that Series A funding. Having the right advisor at this point is really important. This includes attorneys and financial CFO advisors. Your financial statements do not need to be GAAP compliant. Many investors would rather see financials without some of the non-cash entries required by GAAP. However, you'll be required to disclose how your books do differ from GAAP, so you'll have to know what those differences are. Don't worry about trying to grind through an audit. It's just not needed right now.
I completely agree with the points that you have mentioned. Completely agree. So, Bill, let's now talk about later stage rounds, say Series B through E. Again, I know you have a lot of experience here. What are some of the issues CEOs must tackle after a Series A when it comes to preparing their pitch for those larger rounds of financings?
When you're moving into later rounds of financing, it's really all about showing market traction. A company must start to gain customers and show a path to break even and profitability. The specific metrics will be industry dependent. For example, for a SaaS company, for example, that may be the ability to show bookings, customer turnover rates, often called churn, and growth from existing customers, even if the P&L is not yet break even. One question I often see at this stage is, should I raise more investor money or look to M&A? With any financing event, there's dilution. That means existing investors own less of the company after the financing. Let's say a company could be valued at 10 million in an acquisition. If they do a funding round that dilutes existing investors by 30%, the company value, exclusive of the cash raised, didn't really change. And now existing investors' share is only worth $7 million. The company would have to grow 43% for investors to get back to their same pre-investment value. And how long will that take? I lump acquirers into two groups, strategic and financial. We've talked a little bit about this earlier on, but in general, the strategic investor will pay a higher premium because they have a reason they want to be in your marketplace.
Exactly.
Maybe it's filling a product gap, maybe it's more defensive, but they have a value that's not just dependent on your financials. A financial investor, and this often includes private equity firms, will apply various financial averages to derive a valuation. But strategic investors will have a much longer lead time. So make sure you start to cultivate connections with possible future acquirers, even if M&A isn't on your radar screen at the moment.
Absolutely. Absolutely right.
Yep. And beyond financial reasons, there are many strategic reasons to consider M&A. Remember that the volume of company exits via an M&A eclipses the number of IPO exits to the public market by a wide margin. I know everybody, loves the glamour of the IPO, but with 2,900 exits in Q2 of this year, only 10% of those were exits to the public market. Fully 90% of the exits were M&A.
Absolutely. Let's now, everyone, dive into another key subject for companies raising capital. And this is our fourth and final topic, which is how you show ROI and make your case for valuation. So, Patrick, what can you tell the audience about how CEOs and CFOs need to present their case around ROI and valuation to potential investors?
I think that settling on a company valuation is much more of an art than a science. You need to look at both quantitative and qualitative factors. And ultimately, valuation will be partly dictated by investor market dynamics and supply and demand. The Series A valuation provides, in effect, a floor for subsequent valuations, as it is the starting valuation for the company. Later financing rounds may use the basis of a Series A to derive a step-up valuation for future rounds, such as the Series B financing round. You'll want to look at a variety of quantitative factors here, including market industry comparables, or comps, as we like to say here in the financial world. Essentially, valuation using comps examine historical and current trends for companies with similar profiles and in similar market verticals. So then you need to use more qualitative factors when honing in on your company valuation. These will include the overall size of your market and of your addressable opportunity, which technology and business milestones will be met and when, and the experience of your management team, board, and partners. Finally, investors will want to consider a company's valuation vis-a-vis estimated exit values, so that the valuation set for the financing is aligned to the expected multiples rate of return for said investor.
Those are great pointers for the audience, Patrick. Turning now again to Eric. Eric, I know you've completed numerous IPOs, which I ticked off in the beginning, introducing you, and I know that you have also done some SPAC transactions. So do you see an IPO and going public as primarily a financing vehicle, or is it more of an exit vehicle for most companies in the life science sector that you play in?
Laureen, I have a saying when it comes to life science company IPOs. Life sciences companies go to public on a vision, but the follow-on rounds depend on the data.
Mm-hmm.
And for a lot of these companies, it really is a financing round. You look at the cost of clinical trials, it's incredibly expensive. So this is how they can raise the money without going to VCs or private equity. These companies are pre-revenue, so it becomes really critical that they demonstrate to investors how they're managing their cash burn rate. But the real challenge for these companies is VC funds aren't often willing to fund the 100 million or more in capital that many life science companies need to fund their clinical trials in Series B, C, or D. It's really expensive to do phase 2 trials, and even worse for phase 3. Sometimes those companies need to go to the public markets to find the cash to get them to their milestones. I also see crossover rounds at the B or C stage as viable financing options for these companies. But most crossover investors want to see a liquidity event in 12 months or less.
Mm-hmm.
They are looking to get in and get out quickly. So this really increases the pressure for life science companies to go public through an IPO. Now, when it comes to SPACs, I actually see these more of an NMA transaction versus a financing transaction. Mm-hmm. Typically, pre-SPAC, you'll look to do a crossover round. You want to show investors a solid case for ROI and pump your valuation for the SPAC. Then post-SPAC, execute a PIPE as a follow-on. Outside of life sciences, to do a successful SPAC, you really need to show market traction, customers, and strategic partners. You can't go on the vision when it's a non-life science company.
I totally agree with you that outside of life sciences, SPAC transactions work successfully only when a company, to Patrick's point a little earlier, has solid business fundamentals. I mean, let's face it, right, guys? So I have one final question for everyone, and it's for Patrick. So our FLG partners, Patrick, are often asked when it comes to financing, who should a company choose as its partners for the transaction? There's so many players when these transactions are put together. So what do you think are the essential considerations management teams need to make here?
I think, Lauren, choosing the right partners couldn't be more important when planning and executing any financing transaction. It's got to be the right team for that specific deal. They need to have the right relationships, experience, and track record. And most importantly, they need to be able to work well together. With a diverse group of players, from lawyers to investment bankers, CPA firms, and more, herding the cats through any transactions, deadlines, and requirements is a major lesson in project management.
True.
One thing I often get asked is, what about using a private placement agent? When should a company consider using one? Today, with PitchBook and other similar databases, collecting information about investor profiles, including who invests in what and how to contact them, identifying the right investor to contact is less of an issue, certainly, than in the past. the email addresses and the verticals the investors invest in, estimated dry powder, how active is the investor in recent investment deal flow, et cetera, is all available now. You might think the value of a private placement agent has essentially gone away. However, there are some real reasons to consider using a private placement agent when going after financing. For example, if your founder, CEO, CFO team has vendor relationships with potential investors, a well-respected private placement agent can help smooth the path to new connections here. Also, private placement agents who specialize in particular product niches can be very valuable in sectors such as life sciences and technology. So the more detailed knowledge and domain experience of a private placement agent can be extremely beneficial when it comes to the investment market.
That was great. So this actually concludes the narrative portion of our conversation. And thank you, panelists, for joining us today. And I hope our audience learned something from the conversation and enjoyed it. So I'm going to now go to the chat room and see if there are any questions that our audience would like to ask our team. So right now, I'm not seeing any chat questions. So we actually have a couple that we thought would be of interest to everyone. And so I'm going to ask them now. So the first question is, why do we think there is a significant increase in non-traditional investors looking to fund startups? And I know, Patrick, you've got a lot of experience here. So why don't you take that question?
Yeah, thank you, Lorraine. So there are really a number of factors driving this investment increase from non-traditional sources, alternative funds. But first and foremost, these alternative investors want to invest earlier at more attractive valuations prior to liquidation event. That's the main fundamental reason that mutual funds and crossover funds want to get in a little earlier at more attractive valuations. There's a couple of examples of companies where this was applicable. I think a recent one that I reviewed was WeWork. In that report, it highlighted that alternative funds invest in the company because it was viewed actually more as a next big technology wave. Think of like a Google or a Facebook. And alternative investors wanted to get in early to capture this upside surrounding a transformational business. So these are some of the reasons why alternative investors are investing, I believe, earlier in startup companies.
So thank you for that. I'm now still looking at the chat room. I don't see any other questions, but we do have another question that I think the audience would appreciate, which is how do I decide if I'm a CFO or a CEO, how do I decide between multiple offers with different terms? Bill, I know you have a lot of experience here, so why don't you take this question?
Sure. This is where an experienced CFO attorney can help you. You have to look beyond simple valuation difference. One offer may provide a $30 million pre-money valuation, and I got another offer on the other hand that'll offer $35 million. However, if the preferences or other protective provisions are less favorable in the $35 million offer, the $30 million offer might be the best for the company. Sometimes a preference would be, how much do investors get back ahead of common shareholders? And some people will take 2 times of, and if you had a $35 million offer with a 2x preference, I'm not sure that's better than a $30 million offer with a 1x preference. There are intangibles as well. Many investors will demand a seat on the board of directors. Make sure you can work with the individual being proposed for the board and be specific about who that board member is. Don't close the round without knowing the specific individual. Make sure you can work with them.
I can't emphasize that enough in terms of making for sure that whoever gets selected for that board seat, make sure that everything is aligned in terms of values and where you want to take the company. I could not agree with you more. So I'm looking in the chat room and there are no other questions, and I'm going to be mindful of everyone's time. So we will conclude at this point. And I want to thank all the attendees for joining us today. I want to thank our panelists, and we hope you can join us for future events, which will be part of our leadership series at FLG. And we're going to be hosting a consumer products panel called CFOs Building Consumer Brands on November 3rd, and we'll be featuring our amazing CPG and e-commerce team at FLG. So we hope you will be able to attend the event. Thank you, everybody.
You won't be seeing me on that panel.
Thanks, everyone, for joining today.
Have a great day.
Appreciate it.
Thank you.
Bye-bye now.
Bye.
Bye.